Good afternoon, everyone, and welcome to today's Learn at Lunch webinar, where we will hear from OSU Extension Farm Tax Specialist J.C. Hobbs as he provides an end-of-year tax update for our listeners. If you have questions, please ask them through the chat box by clicking the chat button at the bottom of the screen, and J.C. will answer them at the end of the presentation. Additional information on farm taxes may be found in IRS Publication 225, and I will share the link to this and the eFarm Management page in the chat box. JC, I will turn it over to you now.
Thanks, Brent. So what we're going to be talking about this session is really some income tax management opportunities that can be applied at either the end of the year, before the year end, or after the year end closes and before we file our tax return, because there's some things that we can do on both sides to manage our tax bite. One of the questions that I've been receiving lately, and this has been a big one, talking about the market facilitation program, and people wanting to know, since this is working like a disaster payment, is it allowed to be deferred? Well, MFP payments, they're not for damage or destruction to the crop. It's compensation for price damage due to market disruption. Consequently, that does not allow it to be deferred. It's going to be reported as income in the year that it is received. So the market facilitation program, those payments, income you received. The coronavirus food assistance program, it's a little bit different. Generally, it's related to price, not crop damage, crop destruction. Under most scenarios, the CFAP payments, again, aren't allowed to be deferred. So if cash basis farmer, you're going to report those two payments as they're reported to you on a 1099. They're going to go into your tax return as income in the year received, not deferrable. Some tax management tools that we'll get into in this discussion that affect the current year, also future years. We're going to talk about first the fertilizer and lime deduction. Most farmers and ranchers deduct fertilizer and lime application in the year it's applied and paid for. There's some rules that allow some manipulation of that, again, to adjust tax bite. Some depreciation rules, and kind of bring those up to date where we're at under current rules, current law. Prepaid farm expenses for supplies, feed, etc. Income averaging, how that works and why it's important. And then we'll get into some ways of using income in a high income year to fund some retirement options and looking at how to best utilize those for the future when we're wanting to retire. Most farmers kick the can down the road, do not think about retirement until we're wanting to retire, and often we don't have the funds available to cover our retirement needs. Like I said, some tools work after the year close, some of them are before year end. So we'll play with those a little bit. Now the fertilizer lime issue.
Hey, JC, are you cycling through the slides because they haven't changed on the screen yet?
Yeah, I'm moving them. I don't know why they haven't seen them. I'm on, I don't know why you're not seeing those change.
I wonder if you shared the right screen.
Let's back up. Are you seeing anything? Let's see. Let's try again.
I'm seeing you now.
Okay.
All right, now I see the presentation on full screen.
Okay. Does it move forward?
Yes, it did.
Okay, we've already talked about this slide. This is a slide we just discussed, looking at the things we'll be talking about. So I think we're good there. How about, now do you see the capitalization of fertilizer and lime?
Yes, I do. I think you're good to go.
Great, thanks. So what we've got here is the ability to take a current year deduction. And since some of our fertilizer and lime products, the benefit of those go beyond 1 year. So the tax law allows us to elect to capitalize that cost over the useful life, which is often 2 or more years. What this does, if we have a year that we have a lot of expenses and not a lot of income, we can take this, make a deferral to the future, deduct the expense instead of in the year paid, in the year it's actually applied or used, and we can stretch the recovery period, reduce the chance of a net operating loss this year, offset higher income in future years. Now, the nice part about this is an annual election. It can be changed from year to year. Consequently, it's a great tax management tool that, again, most of our farmers aren't utilizing and applying. Some depreciation things that we've got to look at. Depending upon the type of a depreciation election we make, we can definitely impact future years. For example, if we're expecting a large amount of income this year, but we're not expecting that again, we may want to use bonus or 179 to take advantage of that. And we'll show you those two pieces here in a moment. If income is increasing over the next several years, we may want to use straight lines so that we'll have more depreciation in years when the income is growing. If it's stable, pretty much straight line works there as well. If income is expected to be decreasing, we may want to take the rapid write-off up front so that we have more depreciation in years where we have more income. And as that amount decreases, then we've reduced the amount of depreciation we take in those future years. So the depreciation methods allow us to have some benefits of doing some planning, as well as maintaining a more stable level of income over the taxable income over a period of years. Stabilizing our income, taxable income, has been proven to result in lower tax bites or lower taxable or lower tax payments over time. So we actually end up minimizing our overall tax bite for a period of years by managing and stabilizing our taxable income. Now, the rules have changed a little bit for the 179 this year. We've got some up-to-date information here. Currently for 2021, the maximum amount we can take as the deduction is $1,050,000. So we can buy $1,050,000 worth of assets, depreciable assets, put them into service. That's the amount of depreciation we can take. Now, there's an investment limit that does apply. So if we invest more than $2,620,000 in depreciable assets, we end up taking that $1,050,000 and reducing it. So there's some things we got to look at here. Most farmers never get to that level. So that is really not a major problem on the investment side, but it does allow us to take that $1,050,000 and get a current year deduction. Now, the neat part about 179, let's say we don't need that much. We have only $50,000 of taxable income. We can manipulate the amount of 179 that we take this year, take the rest of it as ordinary depreciation in future years, and get the best bang for our buck. So what I've got here is we pick the amount we want to get the desired amount of depreciation we need in the current year. I'm not seeing a lot of farmers doing this. We seem to want to maximize the amount we take. They'll go ahead and take the maximum of, or the whole amount of the depreciable asset in the current year. We don't think much about then adjusting that for the future. Now, bonus depreciation, it came about a few years ago, and it was supposed to go away. It keeps coming back. And current levels are 100% deduction for 2021 assets placed in service. This also goes into 2022. So 100% deduction. And the neat part about bonus is it offsets other income. Now, if you compare that to the 179 rules, you can only take 179 up to the amount of Schedule F income and W-2 wages received. Once we get to that, any amount above that under 179 has to be carried forward. Bonus depreciation can offset all kinds of income, not only W-2 income, it offsets royalties from oil and gas, royalties from wind energy, capital gain income, etc. So 100% bonus depreciation, we can use that to really work against taxable income to our greatest benefit. One thing about bonus depreciation, unless it's elected out of on the tax return, it is assumed to be used. Now, it will start decreasing after 2022. It will go to zero by 2027. So here's how the bonus kind of plays out. 100% for this year, 100% for 2022. So after December 31st of 2022, it starts declining. It goes down 80%, 60%, 40%, 20% in 2026, and it goes away beginning in 2027. Now, a change in that, it used to be for only new property. Now, bonus depreciation applies to both new and used property. So as a farmer, we get to buy a used piece of equipment, apply bonus. We can buy a new one. Also, bonus depreciation applies. So bonus depreciation works just like the 179 in that we both work for new and used property. It's up to 100%. And it does have some impact on other income, bonus more so than 179. Now, like I said, with bonus depreciation, you have to elect out of it, but it only applies to certain classes of assets. That's machinery, that's equipment, that's single purpose ag structures, livestock, breeding livestock that we purchase. So looking at the asset classes for 3, 5, 7, and 10-year property. Now, if you're wondering what that is, if you'll get the Farmer's Tax Guide and look at the depreciation chapter, it defines what falls into 3, 5, 7, and 10-year. Like I said, it's machinery and equipment, tractors, etc., breeding livestock, hogs, cattle, sheep, single-purpose ag structures, grain bins, working facilities, etc., just as long as they can't be used for more than one purpose. Like I said, bonus depreciation offsets all income. That's royalties, capital gains, all of that. So it offers a great opportunity. Now, the neat part about bonus, when we decide to convert an asset to personal use, we are not required to recapture the excess depreciation. 179 does not allow us to use this. Now, here's a tax planning tool that nobody or most folks don't realize from the standpoint of bonus depreciation. If we buy a pickup or truck to be used in the farm business now, and we use it 100% business use between now and the end of the year, so between now and December 31st, it's not used for personal use in any way, shape, or form, so we can write off 100% of that asset using bonus depreciation. Once we get into 2022 and decide we don't want to use that for business purposes anymore, we convert it to 100% personal use. We do not have to recapture the depreciation taken. So it's a very unique tool and something to think about as a way to manage income taxes. And that decision doesn't have to be made before the end of the year. All we have to do is make the decision to purchase the asset. We'll have until the time the asset actually goes into the depreciation schedule. And that's typically when the tax return is due for 2021. So that's April of 2022. Then we make the decision of how we're going to depreciate it. So this tool works very well after the fact of the end of the year. Now 179, remember bonus we said you had to elect out of. 179, you have to elect to use it. And something really unique, and I didn't explain this on the bonus, but on bonus depreciation, you have to elect it on classes of assets or elect out of classes of assets. Whereas the 179, you buy a tractor, a truck, and a implement, You can elect to use the 179 on the tractor or the truck or the implement or portions of each. So it allows you to, again, manage the tax bite by simply working through the 179 rules and picking out how much you want to use and then using regular depreciation on the rest. Like I said earlier, you cannot create a farm loss. So it offsets farm income and offsets W-2 wage income, but nothing more. Once it hits that point, the amount remaining is carried forward. It's not lost, it's just carried forward to future years. Now with 179, you do have the issue of converting that property from business use to personal use. The year that you convert it from business or to personal, and that conversion or that rate is actually more than 50% of it is used for personal use, then we have to recapture the depreciation that was taken or allowed. So the 179 versus bonus, equal deduction in the first year. That got you, like I said, is when business use drops below 50%. Bonus depreciation at conversion does not result in a calculation of gain, loss, or depreciation recapture. That basis is down to zero. The 179, if you change in use, and that occurs with, let's say, within 6 years of a truck, 8 years of a used tractor, then you have to recapture the 179 that was taken as a deduction for the year that it was converted in the future years. So in this example I put on here, I'm looking at a $50,000 truck, 50,000 to make the math equal. In the fourth year, we decided we're going to convert it from business to personal. So we go to 40% business use, 60% personal use. So when you take the bonus depreciation of 50,000, remember there's no recapture rules, so you don't have to make a basis adjustment. The 179 rules, we buy a $50,000 pickup or truck. We fully write it off in the year we buy it. But if you look at, what you have to do is compare it to what the ordinary modified accelerated cost recovery system depreciation would have been allowed. And that's in that third column. We would have been allowed that amount of depreciation. So the 7,500, 12,000, 8,000, almost 9, 3,300. So we only get up to about, I guess, $33,000 of depreciation, 32,500. The remaining 17,493 is the amount that we have to recapture in that year that we converted. So the issue becomes, if you're ever thinking about converting it from business to personal use, you really want to think about how the 179 rules impact that decision. You may be far better off using the bonus if that is a possibility. Now, income averaging is another tool. And it's one of those, again, that can be utilized after end of year. Now, it reduces the current year income. What you end up doing is you figure the taxes for this year. You look at the amount of taxable income. Then, if it's very large, you look back to the prior 3 years. And you look at what was our taxable income there, what's our tax rates. And if it makes sense, we can increase taxable income in those 3 prior years by just simply moving back income in the current year and taxing it at the levels of the prior years. So it levels taxable income over time. Now, the reason I'm bringing this one up, I meet annually, or there's a group of us that meet annually with Internal Revenue Service to go over the farmer's tax guide provisions, make sure everything's correct. 2 years ago, they made mention and they brought to our attention that farm income averaging is not used to the level that it could be to help reduce total taxes paid by farmers and ranchers. Very seldom used. They were asking why. Because what it does is it really helps reduce taxes, and it's not a very high risk decision. So what we do, here's how this thing works. We have about a high income level in 2021, we can then use unused brackets in the for 3 prior years. So if the current year's income, look at 2018, we were $20,000 below the beginning of the 25% bracket. In 2019, we were 25,000, 30,000 in 2020. We can utilize those lower brackets that we're going to experience in 2021. We're going to be in that 25% bracket or greater. So what we've done here is kind of show you through this example that we're going to have move $60,000 of taxable income from 2021. The way the rules read, we have to do that equally over 2018, 19, and 2020. So we move $20,000 into each of those 3 years. We offset that higher taxable income this year. We fill up those lower brackets in the prior years. I didn't put all the calculations in here, but what happened in this scenario was we actually reduced our tax liability by about $10,000 by simply moving $60,000. $10,000, in my opinion, is significant. So again, we're using amounts in lower brackets, prior years, unused levels, and reduced current year tax bite. It works well. And most of our tax preparers, when we talk to them, they realize that their tax software makes the calculations for them. It's just that when we talk to the farmers about it, farmers don't utilize it, don't make mention that they want to use it. They simply use the bonus depreciation or the 179 rules. And we often miss an opportunity of using farm income averaging as a tool to reduce overall income tax, just because I'm not sure how well we understand it. Now, income averaging, it will not impact self-employment tax, net investment income tax. So that seems to be one of the drawbacks. But again, there's an opportunity here. Now, an area that farmers often use, and in some instances, there's been some discussion, is it overused? Prepaying farm expenses. Farmers will often buy feed, other items, parts, etc., that weren't going to be used this year. We're going to have those and probably end up using them in the future year. And since we pay for them, we're a cash basis farmer, we're allowed a deduction in the current year. But there's some rules that will often limit how much we can deduct if the use of that item applies or if it extends beyond the year end. So the IRS created some rules that farmers do apply. It's called a 12-month rule. And what we're looking at is the purchases of feed, fertilizer, etc. Are they going to be used up within the next 12 months or within the next year? So the 12-month rule basically says that farmers can deduct the cost of these prepaid items as long as that use of it doesn't extend beyond either the earlier of 12 months after the benefit begins or the end of the following tax year. So you got to look at the earlier of those 2 points. So what happens is if we buy a lot of feed in, say, October, it's going to go through the winter months. So we're not buying feed again in January. So we're paying for that in 2021. We're going to use part of that feed in 2022. It's all used up before the summer. We're allowed to make that deduction for the expense paid. It's going to be used up within 12 months. The same thing applies for insurance. A lot of our insurance policies, we buy farm insurance, we may buy that and pay for it in November. We'll deduct that cost in November, but it only extends till the next October. Next November, we have to renew the policy again. That easily falls under this 12-month rule. So there's where you get some benefits of prepaid farm expenses, supplies, etc. Now, we often ask, can we prepay interest? So we know what the bank's current interest cost will be for the next 12 months. Prepaying interest is not allowed. We're only allowed to deduct interest that's accrued up until the end of this current tax year. We may not pay it, or we may pay all of it, but we're only allowed a deduction for what applies actually to the current tax year. Any payment that applies to next year, disallowed. So really look at what prepaying interest does. It may not be of the best interest of the taxpayer. However, if they've got a large amount of income, we're worried about making your interest payment next year, it's still a good idea, even though we don't get a current year deduction for that. More on prepaid supplies. It's allowed, but remember the rules limit abuse. So we're not going to be allowed to buy a lot of prepaid items, put them into storage, not use them. There's, again, these limitations that IRS has placed in service. So the prepaid farm supplies amount, if we buy more that's going to be used in the future year, you've got to look at the issue of 50%. Those items purchased, if they are prepaids, in other words, 50% is not going to be used until the future, then we have to look at the total current expenses this year, 2021, that's all of it, including prepaid plus what was actually used. If more than 50% of it's prepaid, then we have to limit our deduction, and it is limited by that amount that's in excess. Now, here comes some rules that kick into place that offset that 50% limitation. If we're a farm-related taxpayer and our total prepaid farm expenses for this year compared to the preceding 3 years is less than 50% of all other expenses, then we don't have to worry about it. So there's some calculations that we have to make. Or if we're a farm-related taxpayer and we exceed the limit due to an unusual change in the business operations. For example, we prepay some fertilizer. We're going to fertilize our wheat ground, and due to the fact that we couldn't put stockers on there, we didn't need to apply fertilizer in the spring. Well, that's an unusual change in business operations. That prepaid fertilizer expense doesn't impact us because we didn't use it due to the fact that we didn't purchase stockers and didn't need the extra fertility to make sure that we could maintain quality forage on that wheat ground. So that's an unusual change in business practice. Then that limitation doesn't apply as well. If there's another exception, if our prepaid expenses, prepaid items are not used due to either a fire, a storm, flood, etc., we couldn't use it because of that problem, then that prepaid goes away. So we don't count it in the overall amount. So the exception is if those items weren't used due to a fire, storm, etc., we can avoid the problem. We simply don't count it. Those issues will be above and beyond our control. Now, I said a prepaid or a farm-related taxpayer. What is that? Main home on the farm. Principal business is farming. And those are pretty much ands. You got to have main home on the farm and principal business is farming. Does it say you mean principal business is farming? That means of our income, the majority of it has to come from farm income or business income. We can't be operating the farm and as a doctor and you got to look at what is your principal business. Also, we could apply the rules of farm-related taxpayer if we have a family member that meets one or two. Let's say dad, mom, they retire or essentially move off the farm. They're still involved in the family operation. They're still pretty much a partner in that operation. And the son or daughter is now on the farm. Principal business of farming for both parties is the farm. Then we can apply that as well. So main home on the farm, or if a family member is on the farm. Now there's 3 tests that the IRS require us to use. And there's 3 parts of this. So here's what the IRS looks at when they decide to do an audit and try to figure out, are we abusing the prepaid farm supply rules? First thing that you have to make sure of, it has to be a payment, not a deposit. So you're going to the co-op, you're paying for feed or fertilizer now that you will take delivery of in the future. It's not a deposit. where we're truly purchasing it, we will be getting that item at specific quantity or at a fixed price in the future. So again, it cannot be a deposit. IRS specifically looks at deposits. If you put money on deposit at the co-op and the co-op pays you interest, that's going to trigger this problem real fast. They're going to kick that out real quick. Has to be a valid business purpose. The purpose of fixing price or supply of the feed or fertilizer is what they're going to be looking at. So we're trying to ward off chances of higher prices in the future, making sure that we have a supply of that fertilizer when we need it. The third one is a little bit abstract. Not sure exactly how to look at this, but must not materially distort income. From what I understand, the way they're looking at this is that's that 50% rule. If we're getting and pushing those limits regularly and consistently, this material distortion of income provision may be what we start looking at. So here's some items to think about. The three-part test is what IRS uses when they start evaluating, are we abusing the prepaid farm supply rules? The last thing to talk about is retirement plan contributions. Often farmers don't think about retirement. We have income in the current year that's extremely large. What do we do with that? We typically plow it back into the operation. However, I've been running into the situation recently, the last several years, working with farmers and ranchers that want to get out of the business. We do all the calculations of when we sell our machinery, sell off all the equipment, sell off the livestock, and we do all the calculations of the tax bite from the depreciation recapture, etc. We find that once we pay Uncle Sam, we don't have enough money to put into the bank to fund a retirement account. Social Security doesn't cover it because we've not paid in enough. Every time we have a large income year, instead of paying self-employment tax, we decide to buy equipment, plot money back into the operation, which is not a bad idea, but it doesn't lend itself to the point in the future when the farmer and his wife decide to exit the business and do something else. So these retirement plan contributions are something to think about, because what you do is you deduct contribution in the year of the high income, and we don't pay tax until that money is withdrawn at retirement date. So we deduct the contribution, it grows tax-free, we pay the tax when we start withdrawing it. Works great. Funds a retirement account, tax shelters income, and it gives us an opportunity to take a current year deduction. Now, there are some things that we have to take into account. We have to make these contributions in a timely manner. For individual retirement accounts and self-employed retirement plans, we have up till the date of the tax return being filed to make that decision. So with IRAs, these self-employed plans, we can decide by April 15th of the following year to fund that and get a deduction that offsets income for the prior year. A great tool, gives us an opportunity. The IRS, Treasury, plus others, put this in place to help farmers provide an option to create a retirement plan. Now, simple plans, these are not quite as lucrative from the standpoint of when you place in service. It does the same thing. You deduct the contribution, you pay the tax on the withdrawal, so it is tax sheltered, but your decision has to be made by October 1st of the current year. Other retirement accounts, you'll have until December 31st in order to put those into place. So most of our retirement plans, you'll have until the end of the year to decide to fund those. IRAs after the first of the year, simple plans, you're going to have to think about that because that applies 4 months or 3 months before the end of the year. So you have to make your decisions early. Now, some things about tax management and planning. You have to think about tax planning and management all year long. Now, granted, this presentation came really late in the year, there's still some opportunities that can be taken into account to manage our tax for 2021. All we have to do is to understand what they are. So the basic tax law knowledge, you're gaining some here, but you need to sit down with your accountant, work through some options, discuss where you're at. When you don't know, be sure to ask questions. Often what I run into, instead of asking, well, what if I do this? This is what I did, now fix it. A lot of times we cannot fix what we've already put into place. We can mitigate some of that problem, but we really need to talk to our accountant or tax planner prior to end of year to look at opportunities to use those what if statements. If I do this, then what happens? Will that give me what I need? Are there better options out there? So professional advice may be needed, often needed, in my opinion, is a requirement to do good, sound tax planning. Year-end tax planning, always useful. Remember our goal, we're wanting to level taxable income over the lifetime of the business. If we do this and do a good job of it, we will minimize the overall taxes paid over the lifetime of that business. And this has been proven several times in several different research and with farm operations. Here's the evaluation link. It's on your screen. I thank you for your attention. I understand that we're supposed to look at some questions. I believe there's some in the chat box. The Farmer's Tax Guide came out in October of this year. There's some new information in there. Go to that website there, or you can go to Google, type in the Farmer's Tax Guide. It will bring up the 2021 information. The tax guide for 2021 returns is the current year or the current tax guide that is available. Have questions after this is over with? There's my contact information. Email me. That's the best way to catch me. I travel around quite a bit. So if you'll email me, jc.hobbs@okstate.edu, guarantee that I'll get back to you, answer your questions. Now on the chat side, bear with me.
You have about 3 questions, it looks like.
There's 3 questions there. Okay. So is depreciation based off the appraised value? Great question. No, it's based upon the purchase price of an asset plus any other items that are added. So depreciation. So we buy a new tractor and we have a front end loader on it. You're looking at the price of both parts, the tractor and the loader. So it's the whole package. That's the amount of depreciation you look at. So it's the purchase price plus any additions. So the next question is, does the income averaging affect the future years? Yes, it does, but not like we think about it. So let's look at the example here of 2021 being having a large amount of income. If we move income from this year back to the prior 3, fill up some of those lower tax brackets, and next year we have a very high amount of income again, even higher than 2021, we've created a situation where we can move it back to 19, 20, and 21, fill up the brackets further, again, reducing our overall tax bite. So yes, it can affect the current year and future years. It's just not quite as neat as the first year that it does apply. Let's see, the next question. Non-farm business owners, brief tips for non-farm owners in the same excess income problem this year. Farm income owners non-farmer operations, businesses, don't have the ability to use income averaging. But all the other tools that we've talked about do apply. Non-farm businesses have the ability to prepay some items, for example, or pay down accounts payable, things like this that can affect or can impact the amount of total taxable income. So there's some opportunities here. So non-farm businesses, they do have the same tools, for example, depreciation, etc. Farmers have more of these. If you look at the tax code farmers, ministers, and military, those three groups have the largest number of benefits that are listed in the tax code than all other businesses, individuals, etc. So yes, when you ask about those, there is an IRS publication for non-farm businesses that provide pretty much the same information as the farmer's tax guide. A great place to get information. Brent, I guess you're going to have to fill out or tell them how the recording is available. How you did that. Brent, are you going to send out the slide deck? Because we've got a couple here wanting it.
Yes, I plan on, I can, if you'll email me at brent.ladd@okstate.edu, I can share you the slide deck, and the recording will be up on YouTube, and I'll share that link once it's available. And in the chat box, I did share a link to the survey as well as a link to the IRS publication 225 that JC mentioned. So thank you, JC. And thanks everyone for joining us today. We'll see you again on January 18th, where we'll hear about keeping better farm and ranch records. Will be the topic of that webinar. And so if there are no other questions, all in the webinar today, and we'll see you on January 18th.
Thanks for inviting me today, Brent.
You're welcome. Thanks for the presentation. I don't see anyone typing, so I think I will end the presentation now.